Good afternoon, everyone. Welcome back to Protect Your Farm Business, where we talk about agribusiness related topics. I am Ashley Westerhold, and I work for the University of Idaho Extension. So today we are doing part 2 of our 3-part series discussing and understanding your financial situation. And so if you haven't already, please go watch part 1 of this series because we will be starting off where we ended last time. So let me jump into today's topic. So, as you can see from the PowerPoint, we'll be discussing financial measures. So we talked about last time liquidity, solvency, profitability, and now we're moving on to repayment capacity. And so I just want to move my video because it was in the way. So little technical difficulties, but we'll get through it. So we'll talk about financial measures and the repayment capacity today, and then financial efficiency. So repayment capacity. What is the repayment capacity? Well, it measures the cash flow generated by the business. It's having enough cash income to meet family living expenses, income tax payments, interest and principal payments, and it is similar to the current ratio in the working capital, but it takes into account all cash inflows and outflows. And so the first ratio is the term debt coverage ratio. So it's the number of times the business can cover intermediate and long-term debt payments. And this is calculated by taking your net farm income from operations plus your net non-farm income plus your interest on term debt minus your family living and taxes, and then divided by your term debt principal and interest. So just like we did last time, it's the term debt coverage ratio is your ability to cover intermediate and long-term debts. So it is a strong ratio if it's greater than 1.5, it's caution 1.5 to 1.2, and it's vulnerable with some 1.2. And so greater than 1 means that there is sufficient cash flow. So therefore, you do have cash at times that you do need to pay the debt. So then there's capital debt repayment margin. And it is the difference between cash available in intermediate and long-term debt payments. So that is calculated by taking the net farm income from operations plus net non-farm income minus your family living and taxes and minus your term debt payment. So with the capital debt repayment margin, you want a strong, large positive, caution is a small positive, and vulnerable is a negative. So general rule, if the capital debt repayment margin is greater than depreciation expense, the farm has sufficient earnings to replace capital investments. And that's really important to be able to replace those tractors as you need to. So make sure that your capital debt repayment margin is looking good so that can help you in the future. So you can compare to similar operation and past trends for a benchmark if you're interested. So then we go into this last part of the financial measures, which is financial efficiency. So financial efficiency is the value of production per physical unit of input, and it's the value of production per unit cost of input. And so we'll look at the asset turnover rate, which measures how efficiently capital invested in the business is being used. So it's gross revenues divided by average total farm assets. How many years it would take to produce products with a value equal to the total assets. So, turnover asset rate. A strong rate would be greater than 45%, which would be about 2.2 years. Caution would be about 45 to 30%, and vulnerable is less than 30%, which is 3.3 years. So you compare them to similar operations, but it really does depend on your type of operation. So crop and cow-calf, typically you want an asset turnover rate. You have an asset 4 to 5 years. Dairy and vegetable, usually 1 to 3 years, just because it is so much more invasive. So leased operations and service businesses typically under 1 year, because you need to make up for using that equipment until it's dead that year, and maybe you are getting enough business to where you have to replace your equipment within a year. So operational ratios. So we have the operating expense ratio, the depreciation expense ratio, the interest expense ratio, and the net farm income from operations ratio. So we will show each as a percent of gross revenue, and they will sum up to 100%. So we have the operating expense ratio, which is the percent of gross revenue used to pay for operating expenses. So it's total operating expenses minus your depreciation expense divided by gross revenues. It's strong if it's less than 60%. It's a caution if it's 60% to 80%. And it's a vulnerable if it's greater than 80%. So farms with lots of rented land and machinery or hired labor have higher operation expense ratios. And high ratios signal for repayment problems. And that should make sense. If not, please ask me a question on the live. I'm here to answer them. So, next, depreciation expense ratio. We have the percent of gross revenue used to cover asset depreciation, and it's depreciation expense plus capital adjustments divided by gross revenues. So it's strong is less than 5%, caution is 5 to 15%, vulnerable is greater than 15%. So you compare these two similar operations and past trends, and a high ratio may indicate underutilized capital assets. So if you aren't using that machine as much as you thought you were, then you maybe shouldn't have bought it because it's costing you more money. Farms with large investments in newer machinery, equipment, and buildings have higher ratios. So interest expense ratio is the percent of gross revenue used to pay interest expense. And so it's total farm interest expense divided by gross revenues. So a strong is less than 5%, a caution is 5 to 10%, vulnerable is greater than 10%. A high ratio may indicate too much dependence on borrowed capital or high interest rates on existing debt. And then there's the net farm income ratio, percent of gross revenue left after all expenses are paid. So it's net farm income from operations divided by gross revenues. A strong one would be greater than 20%. Caution is 10 to 20%. Vulnerable is less than 10%. So the general rule is that the lower the interest expense ratio, the higher the net farm income ratio. And you can compare those to similar operations of past trends as well. And so we actually have this pie chart that I wanted to show, which has the operational ratios broken out into this pie chart, as you can see. So your net farm income ratio should be about 20%, depreciation expense ratio 16, interest expense 5, operating expense ratio 80. And so you can see that's more than 100%, but it is how you make up your pie. And so I really wanted to go over again just what we've gone through in the past 2 of our Protect Your Farm Business meetings last week and this week. We talked about all of the Sweet 16 ratios. And so throughout these PowerPoints, we have gone through what good indicators are. So that's strong, caution, and vulnerable by determining which ratios for you to really use when discussing your business. So I would encourage you to go home and work on these ratios, and I know that they will be helpful for you in the future. So If you need help, again, think about our farm business management and benchmarking program. Again, that information is in the description box. So we will end on this procedure for diagnosing a farm business problem. So you can see that there's 3 sections: liquidity, profitability, and solvency. So if unsatisfactory in liquidity, refinance current debt, slow your expansion, liquidate some assets, reduce your operating debt, decrease your owner withdrawals, improve profitability. So if solvency, if unsatisfactory, retain more net income, sell some of your assets, reduce your debt, liquidate assets, improve profitability. And so if profitability, if unsatisfactory, check volume of production. If too low, check volume of resources. If too low, look for expansion, use of credit, hire more labor. And then we can look at economic efficiency. If too low, check selling prices. Are you getting the best price for your product? If your selling prices are too low, use other marketing tools like the futures market. Check other markets. Could you go into a different market, a niche market? Improve your product quality. If a physical efficiency, if too low, improve production practices. Use higher quality inputs. Change enterprises. And then lastly, input prices. If too high, check other suppliers, buy raw materials, try used equipment instead of new equipment. And so with that, that's all we are going to discuss today. I hope you join us next week, and I hope this was helpful. Please let me know if you have any questions or comments. Feel free to email me. Thank you. Have a great day.